Namaste, Sat Sri Akal and Adab. Welcome back to another episode of One on One with Mr. Bond. Today we are going to be in conversation with Ritesh Pathak, Executive Vice President of Motilal Oswal and Retail Channel Head. Before I invite Ritesh on the screen, let me explain to you and share some of the very interesting data which has come to my attention, and very positive data as far as the Indian growth story is concerned. Today we are shooting this video on 1st of March 2024, when Q3 2024 GDP growth has come to almost whopping 8.4%. Markets have taken a cue from there. They have gone up almost 850 points up on Sensex. Another data which is very interesting data is 4.2 crore unique investors in the mutual fund in the financial markets. But that is less than 5% of the working age population, a long way to go as far as Indian markets are concerned. When this number grows, automatically that retail participation, which is already growing through the SIP book, will also add to the liquidity. And when this other number also grows, which is only less than 5% of working age population, grows to say 7%, 10%, you can imagine the numbers. It will have a multiplier effect. 25 lakh crores of mutual fund AUM, the corpus of the mutual fund industry, grew to 50 lakh crores within a short span of 4 years, likely to grow to 100 lakh crores by 2030, which is almost 14% CAGR. Another interesting data, 4.5 trillion market cap of India's equity markets is likely to grow to $10 trillion by 2027, based on various analysis of global investors and global analysts also. That is also showcasing almost 14% CAGR as far as the India growth story is concerned and the market is concerned. So we are talking to Ritesh at a very opportune time. Very interesting times are ahead of us. Of course, there will be some global factors which will come as a stumbling block, but those are the propositions or the value buying opportunities as and when the markets dip. So we should not get perturbed during that period. Now, let me explain to you what is SEBI categorization of large, mid, and small cap. The top 100 companies in terms of market capitalizations forms the large cap space. 101st to 250th company in terms of market capitalization forms the mid-cap space, and 251st company and beyond in terms of market capitalization forms the small-cap space. Now let us talk about large and mid-cap as a category. What does that mean, and what is the SEBI categorization and definition of large and mid-cap? Minimum 35% allocation to large cap, minimum 35% allocation to mid-cap, and the small cap and beyond is what the fund manager will take a call, so that 30% allocation, which is at the discretion of the fund manager, will depend on the fund manager's call in terms of where should he be overweight large, mid, or small caps. Now let me invite Ritesh on the screen. Welcome, Ritesh.
Hi, Sunil. Thank you so much.
Absolutely. Ritesh, we are meeting on a very good day, very auspicious day today, when the Q3 results of GDP growth have really numbed the markets in terms of on the positive side. And that's where the markets have taken a cue, and they're just going through the roof as far as today's rally is concerned. Of course, how far it will be sustained, etc., that's a different story. So Ritesh, we will speak about, we want to speak about Motilal Oswal QGLP to start with. What does that mean? What is QGLNP? And how do you apply that QGLP to your large and mid cap space? We are specifically going to speak about your Motilal Oswal large and mid cap scheme, which is doing exceedingly well. I think it's in the top quartile in terms of performance and beating peers on an ongoing basis. So if you can throw some light on the QGLP process and how is it applied on large and mid cap space?
Yeah, Sunil, of course. So QGLP basically stands for quality, growth, longevity, and price. So if you look at in terms of investment, all the expert would always talk about that you invest into companies which are qualitative, companies which can sustain, market volatility over a long period of time. So if and quality can be of two types. One is the quality of the management, other is the quality of business. So let's say quality of business is quite good, is doing fantastic. However, the management is not up to mark, or the vice versa. The management is superb, or the opportunity in the industry is very, very limited. In both scenario, a business will not, flourish much. So quality stands for quality of management, quality of business. Now, how should we understand exactly how should the quality denote? So we look at return on capital employed, ROCE, as far as the AMC is concerned, and we focus on companies who have a relatively higher, return on capital employed, high quality in terms of the company and the management. Coming to the growth part, I think it's the simplest. There's a saying in the market that prices are slaves of earning, which basically means if the company continue to make more profits in the future, the prices of those companies also moves up. So what we say also follow the same thought is that we intend to choose those companies which are qualitative. However, they must also be growing their profit sustainably over a long period of time. So we tend to look at companies with a higher profit growth, or you can say the earning growth in the coming times. So quality plus growth, that is ideally, if you continue to do so in a long period of time, longevity time, it is going to give you wealth, creation for the company and for the investor. However, the another important thing is that what price are you buying these companies? So even a good quality company at a relatively higher price may not give you desired result, because you end up buying those companies at a much relatively higher price. So we also have put up one mechanism of understanding that we do not buy good companies, high quality companies at an irrational price. So we look at various
So,
models.
quality companies at any price, which was the narrative of the last 1.5 years, that's not the story which you, Motilal Oswal Mutual Fund, follows. You are talking about quality at a reasonable valuation and a reasonable price. Am I correct?
Absolutely. So there's a terminology which a lot of people use it, buy at any price. We don't follow that. We believe that you have to buy companies at a price from where the size of the, or you can say the drawdowns are limited, and the opportunities on the coming times are far better in terms of making some money out of the entire investments. So we tend to look at some valuation models, Sunilji. So we, for example, price earning to growth model or a DCF model. So multiple models we try to inculcate to ascertain companies. So in a way that they are coming at the right price and they are not actually could be a big drawdown to the portfolios.
What is PEG? You spoke about price earnings growth. So what is PEG for the viewers understanding, and how do they read that PEG ratio?
Absolutely. So PEG basically stands for price earning divided by the growth, which is earnings of the company. So every earning will have a price to earning, PE of the company. And you also every quarter you will get a company publishing a result, and we say the company has a earning growth of a company is XYZ. Now let's say example, if you're buying a company with a PE of 20, and somebody will come and say, oh, 20 P is very, very relatively high. But what if the company is growing their profit at 25% per year?
So PE divided by, so 20 divided by
25. So now suddenly it is lower than 1. So
Correct.
Anything which is around 1 or slightly lower is very, very attractive in terms of the investment, because the growth is higher than the PE or equivalent to the PE.
Correct.
So as you move high, let's say you cross more than 2.5, then start to become expensive. What price are you paying for the growth?
So you mean to say up to 2, it is a reasonable valuation? Up to 2 PEG is reasonable?
G. So anything around, let's say 1.5 is very attractive. 2.25 will be, I'd say, reasonably still fine. But if it's getting closer to 2.5, 3, it's getting very expensive. And unless until the company continues to, outdone the growth in the future.
So what is the PEG ratio of large and mid cap scheme? Is that at the scheme level also?
Yes. So what we look at is at times you may not be able to follow it for each and every stock, because I tell you this, for example, Sunilji, for let's say if you have to evaluate a company for today, there's a lot of new trends coming like renewable energy or let's say EV for that matter. and you might be getting some EMS for अभी बहुत common एक आजकल चलता है EMS, electronic manufacturing services. And a lot of these companies are doing quite well, and their earning growth is 40, 50 odd percent. So if you are buying these companies, you have to look at today opportunity in terms of earnings over next 12 months and 24 months. So if you are buying at a earning growth of higher earning growth, then your opportunity at a today at a XP, let's say today company around 25p, the earning growth is today 25, may move to 50. That will help you to actually make a very, very reasonable good trade in those companies.
Okay. So now explain to us this particular slide, best exponent of high quality, high growth style of investing following the QGLP philosophy, sticking to our core DNA. So this is that, the chart which shows that AMC is 25%, value style is 50%, and the balance is 25%. So how do you read this chart and what does it indicate?
Yeah, so basically, there are various styles of investment. Everybody knows, for example, there's value style. Of late, it has done very well. Then there's a growth style. So if you look at a lot of multi-bagger companies, and if you have to put it into which chart they'll come in, most will fall into a growth style of investment. Growth is nothing. Let's say a company which is growing its profit yearly 20%. So price is 100 today. Profit growth is, let's say, 20%. And let's say the profit growth is equivalent to price growth. So we are expecting the price also to grow by 20%, let's say 120 rupee next year. Company is again expected to grow at 25% next year. So you are actually growing your profit every year, and according the prices are growing in line with the profit of the company. However, the second scenario is the value investing, where the company price is today 100, and due to some reason it has fallen to 50 or 60 rupees, and you believe it has come back to the fair price or the intrinsic fair value of the company. Now, here you are not taking a big call on the growth of the company for a long term. You believe that today it is trading at a much lower price, and it should be come back, and you will make a decent money on that trade. Now, that is basically value style, not looking at the future growth of the company relatively, and rather playing on the fair value of the price where the stock is trading below that. So that's a value style. We follow the style of quality and growth. So our style is basically towards those companies which will have good growth over a period of time, and we tend to be beneficiary of that. We don't, in our portfolio, you will see, let's say, companies which are high growth companies, rather than companies which are low growth and more value, trading below than the fair value. Those kind of companies not see that. Now, there are better players, other players in the market who are in the value side. So we say we are one of the best players on the high growth, high quality style, which is one way of looking at it. And there are other good players in the market who are good proponents of, let's say, a value style or a contrast style.
Correct.
So that's the other way of the a style of investment. And this another investment is to complete. One is the highest quality. So there are companies which is with the peak of the quality. So you will see those companies for a very long period of time, good market share also. However, their growth will be slightly muted compared to the highest quality, high quality, high growth, and then you have the value and contrast style. So we are generally into those companies which are into high growth. Now in an investor's portfolio, generally, Sunil ji, nobody like to invest everything into one style of business. Okay, a style of investment. So in the industry, there are a lot of players in the value contrast style in the industry. Very few players in the growth style and the highest quality style. And we believe in the high growth, high quality style, we are one of the best proponent in terms of the.
So you are champions of a specific style of investing, which is high growth, high quality, high growth, the other way around, right?
Yes.
So that's the way differentiation. So there is a growth style of investing, there is value style of investing. And what you are saying is we are differentiated from these two styles because we are not only talking of growth or value, but we are talking of high quality at high growth. That is, you are the champions at that.
Yeah.
Now let us talk about some of the frameworks which you have put in place for the, I don't know whether it's for the fund managers or it's for the the investors. So stock weightage and sizing, if you can just throw some light on that.
Sure. So these are primarily risk frameworks, Sunilji, which we have put in place. These are at the portfolio level and which the managers have to adhere to. So
Correct.
primarily coming to the first measures talked about stock weightages and the sector sizing. So the idea is that the manager should have a minimum weightage in a stock and the maximum weightage in stock, which we have put in place. So, generally you see in our portfolio, we have put a 2%, kind 1.5%, 2% on the lower side, the manager should have allocation. And the higher side, he can move up to 8 to 9% if there's a market situation and the mark to market takes it there. Idea is that if you're buying anything below 1%, anyway, you're creating a long tail.
Correct.
Either if your conviction, you build it up maybe 1.5%, 2% or more than that, or you exit the stock. Similarly, if the stock in the portfolio does well and the allocation is getting bigger, the manager should keep it in a fair percentage and not be a very, very heavy allocation in the portfolio. So we have put this sector, this stock wages of, let's say, on the bottom and the higher side, so that there's a good balancing in the portfolio. So that's
So will it be more like a equi-weighted portfolio? Is that what you are saying amongst all categories of your schemes?
So it's not be absolutely equated portfolio, but yes, you will see that where portfolios allocation are more balanced. So for example, a larger mid-cap fund, you will see while portfolio have around 30 odd stocks, the highest allocation is around 6.5% only.
Okay.
And its top 10 concentration is actually lower than the peer group.
More than the peer group.
Yeah, so that's very interesting. Despite of having 30 stocks, we are having a less concentration of top 10. But like you said, it's more balanced portfolio. So we have 2-3% on
And
the
in
lower
spite
side.
of that, your stock concentration is less in terms of the number of stocks versus the peer groups, which will be almost so that over diversification to the extent of 65, 70 stocks also.
Generally, yes. Yeah, generally,
Right?
yes, you're right.
What does diversification strategy mean in terms of risk mitigation, and how does it work?
So basically, there are two. We primarily across our portfolio, we're looking at around 30-35 stocks in our portfolios. And
So that's enough diversification according to you?
Yes. So Sunilji, if you remember, in the unsystematic risk framework, it is over 100 of years of or more than 100 years of research says that 25-30 stocks are good diversification. Uh, uh, Also depends on the portfolios we are managing. So today, all our portfolio is under 10,000 crores. Larger mid-cap around 3,000 plus crore in terms of AUM. And there is an ample diversification within 30-35 stocks. We have allocation across sectors, across themes in the portfolio. So that seems to be a very ample diversification in the portfolio. What we have done is that we have also put a sector sizing framework. So the manager, it could happen that at times you could have a very high allocation to certain sector, which become a predominant part of portfolio. And if the sector does not do well, it can impact it. So what we have done is that basically we have put a sector sizing so the manager generally, on the upside and lower side have a weight of 7.5% in comparison to a benchmark. So he will not be over allocated to one sector or under allocated to one sector versus the benchmark. So that is what you will see across our portfolios, including the large and mid-cap fund, which we are talking about.
Awesome. What is profit taking a stop loss strategy? And
so this is primarily a proprietary framework we are working on. This framework helps us to identify companies, which are a drag to the portfolio, or let's say laggard to the portfolio, and looking and getting those, purpose from the framework. A manager can take a corrective action in the portfolio, whether to exit the stock or to trim the stock, or maybe in case there is a reason to held on to those stock after a discussion with the investment committee, that can be done. But this is an indication and a nudge to the manager to take a corrective action in the portfolio, both on the profit booking and also on the nudge to exit the company if there is a drag in the portfolio because of, let's say, the company not doing so well.
So is this the learnings of the COVID, post-COVID era of for Motilal Oswal?
So, Sunilji, there has been a lot of, you would have seen addition to the risk frameworks. And like
Correct.
you said, it is contributed to the pre-COVID era, 1 or 2 years where we found this quite challenging. And we, like, we worked upon it. We modified some of the our strategies and added more risk framework in the portfolio. And it helped us to emerge as a better investment manager. And I'm sure you would all be seeing in the portfolio performance also.
So basically, you'll be more dynamic than what you used to be earlier. You'll be more quick-footed in terms of either booking profits or trimming your losses.
Absolutely. So what we have understood or learned, especially, is that the cycles have become more short.
Shorter,
And
absolutely. I was just going to say that.
yes, and the only way you can continue to be a consistently delivering reasonable experience to the investor and the partner is by ensuring to actively managing the entire risk and the change in the portfolio. So
What is stringent liquidity? So that's the last one in terms of the risks and how do you manage risks?
So we have a framework to check across our portfolio at what minimum number of days we can exit the entire portfolios. For
So basically,
example,
the floating stocks of the that particular stock, and then how soon can you
absolutely,
exit, etc.
our allocation. So we aim to should be able to exit a good part of portfolio within a few number of days. Idea is not to have a allocation where the liquidity becomes a problem. We have a
Even in
risk.
the small cap space?
Yes, sir. Even in small cap space. So even in small cap, we can actually liquidate the entire portfolio in around 4 days, 3 to 4 days.
Okay.
So we have appointed risk managers to keep nudging the management in terms of wherever they see a risk coming out, and especially on the liquidity front, this is being tested on a monthly basis.
Awesome. Awesome. Now let's talk about the house investment themes and its relevance in the current markets. Hospitals and healthcare, lenders with increase in NBFCs, insurance and interest rates will go down. This play also will help us. Tech and tech services, China plus one through chemicals, EMV and garments, make in India through engineering and defense, and urbanization through discretionary and retail versus staples, leisure, and focus on luxury. So if you
Right.
can just throw some light, not necessarily on each and every segment, how are these house themes relevant in the current context?
Absolutely. So for last 2.5, 3 years, we are following this. So we believe that there are certain themes which will be the beneficiary of this economic growth. At the start, you mentioned that morning we had a very good uh, GDP number, 8.4% in terms of the last quarter. I think it's very clear that the next few years are going to be very, very good for the economy. And while what one did not see in versus the last decade, let's say, where we did not see a capex cycle for that matter. Now,
Correct.
this last few years are indicating towards a different cycle where they see a lot of capex company going to be a beneficiary of the reforms which have been brought in by the government over the last 7, 8, 10 years. So we believe that especially in the defense segment, we are very positive. We believe the Make in India through PLI is going to be a very beneficiary for a lot of these companies. So one theme we look at those companies in the defense side. Also on the PLI, Sunilji, morning again we heard a news that Tata is coming up with a semiconductor foundry establishment in the country. So first for the semiconductors, again, this is something we could not have thought of, let's say, 10 years back.
Correct.
So a lot of companies are being beneficiary of this, PLI themes, Make in India themes, which is nothing but a China plus one story. Lot of companies which are, let's say, exiting China, and they're coming to the Southeast Asian country, including in India, Vietnam, Indonesia, these countries, and we are beneficiary of one of those beneficiary country. Apple, we never thought about manufacturing in India. So end of the day, there are a lot of Indian EMS companies are becoming beneficiary of the entire change. and we believe that there are some good companies to invest in this part of the growth, and where the growth will be earning growth of these companies will be much higher than the market. So this is one space we like, China plus one,
So
playing.
it will fit in very well with your QGLP process also.
Yeah. So if I have to just tell you, if you look at the earning growth of some of these companies, they are in excess of 25-30%.
Yeah.
And this industry is actually growing. Not only a company, but the industry is growing at a 20-30%
But
rate.
Ritesh, all these segments and the themes which we have just discussing currently are not necessarily represented in the large cap space. So they may be the mid cap and the small cap space, and that's the reason why we see some sizable allocation to small caps in your large and mid cap space. Also, we'll discuss that. But is that the reason why we
Yeah,
have a
absolutely
little?
true. Absolutely true. If you look at some of the themes you just mentioned, for example, hospitals, chemicals for that matter, is also a
Correct.
class for China plus one.
So this nothing is represented in the large cap space.
Large cap, absolutely. But if you look at again, there are NBFCs which are we believe could do well in this space. So that we have some opportunity to play in the large cap space. Insurance, which has not been so interesting part of the market over the last few years. We believe that there is this could be a good investment for the future as the interest rates are coming down. We believe that now, after a period of 1.5 years when US had trouble in terms of the internal inflation, etc., the technology company has also took some brunt in between. That should start doing better.
But we are
And
not in the large cap space of technology, from what I
yes,
understand. We are more in the mid cap space and the small cap space. Am I right?
correct. So yeah, so coming to that only. So if you look at the results also for the last 2 quarters, we saw that the mid cap companies actually delivered much better earnings than the large cap peers.
Correct.
While we expect the large cap also to catch up, right now the mid cap companies are actually doing much better in terms of managing the entire change and the growth. And that is why if you look at our, like you mentioned in our portfolio also, Sunilji, large and mid-cap portfolio also, we have a 37% allocation to mid-cap and around 27% to small cap.
Yeah,
And
yeah.
some
I'll
of
come to that also in terms of why large cap, why mid cap, and why small caps. So we'll discuss that. Now let me explain to the viewers as to what happened in calendar year 2023. So if you put that in perspective and we take that journey forward, so we will understand where we stand right now. So in 2023, Nifty 50 calendar year की बात कर रहे हैं हम, delivered almost 18% return. Nifty mid cap delivered almost 42 or 45% return, and Nifty small cap delivered the 55% approximately returns. But the PEs, the price to earning growth, was 4.6% for Nifty 50, negative 1.5% for Nifty mid cap, and almost 66 to 70% for Nifty small cap. In terms of the valuation, Nifty small caps has actually grown the most. But at the same time, the earnings growth, if you see, Nifty 50 had delivered an earnings growth of almost 13%. Nifty mid cap had earnings growth of 45%, but the Nifty small cap was negative 9%. Now, Ritesh, based on this data, so that means there is a lot of merit in the argument saying that large cap going forward should do well because of the valuation prospects also, because of the FIIs coming back into the Indian context and their money chasing large cap space. Emerging market index and the India weightage going to 18.2%, which will start from March onwards. That means the reallocation will again happen into Indian equities from the global investors. So all that will drive the large cap space. So most of the flexi cap, the large and mid cap, the multi caps, which are more in heavy weights on mid and small caps, will also have a rotational rally or realignment towards large cap. Am I correct in saying that?
yeah, absolutely. There is a case for the large caps looking at the valuation part. You said it yourself, last 3 years, if you see a good part of last 3 years, there was an outflow from the FIIs, barring the
Right.
last few months when we are seeing the inflows from the FIIs in India. Like the Indian weightage in MSI index have increased. There is a big thing across the world that next few years we believe the fastest growing economy also in the world. So of
Plus
course,
political stability, which is very important.
plus 10 years of very, very stable government at the center, a very, very reform-oriented government as far as the country is concerned. So yes, there is a lot of expectation. And because of, very simple, the FIIs do drive the large caps, that's for sure, especially top companies. And we all know that the weightage of the top 10, 15 companies are very, very high in the index itself. And that's what happened. So FII were out of the Indian market or exiting the market, outflows were there, and we saw correction. And we should see more FIA participation this year. And with the valuation currently, we are with the large cap and the earning growth expectation. A large cap seems to be a very good play from the risk reward basis.
Right.
The drawdowns seems to be comparatively lower, and the expectation to be a better, return are slightly higher. It's a good play. Having said that, even EPS earnings have remained very, very stable, Sunilji, and some of the companies are doing very well. So we believe you have to go theme based. That's what we are saying. You may not go the market cap specific. You should go theme specific.
Okay.
And that's why when we in the last when we spoke in the last section, we're talking about the themes. So those themes, maybe a niche, for example, just to add you, maybe a theme on consumption on a luxury side,
Right.
right? Today, when consumption, people believe is staples and is discretion. So within discretion, there's a space which is luxury. Now, if we see the growth of this luxury kind of section in the last, let's say, 1 year, 2 year, it's been very, very astounding growth in
Correct.
terms of the earnings growth of these companies. Now, they might be mid or small, but their trajectory of earnings or price movement may not be similar to index. So choosing the themes within the market caps and playing those themes is what we are trying to do. We are not saying the large cap is good or the bad mid is good or the small cap is good. We're saying there's certain themes which will have a better growth than the market, and that is where our bet is on the investment on those companies.
So that is reflected here also. Your large cap, in large and mid cap, your large cap allocation versus the industry or the index allocation is 36% versus 54%. 37 in mid cap versus 42%. But you have the allocation in the LMN to 250 is 3% in small cap, but your allocation is almost 27%.
Correct.
What we just discussed just now. So not many companies of the themes which the Motilal Oswal as a house is following is not represented in the large cap. That's the reason why you're not maybe overweight in the large cap compared to the peers, compared to the benchmark.
Correct. Absolutely correct.
What is your 35% is the minimum, so you are there at 36% currently. In the mid cap space, you are at 37% versus 42. But the majority of your overweight is at in the small cap space. Will that not bring volatility in the portfolio?
Not exactly. We tend to, we tend to look at small cap as a very small companies, right?
Right.
So if I, generally when I do presentations and I ask all our partners about, what is size of small cap company, they tend to say 3,000 crore market cap, 4,000 market cap.
Those days are gone.
Yeah. So you will be surprised, Sunilji, that the average market cap of our small cap allocation in the portfolio is close to 21,000 crores.
Oh my God. So they are more like a small caps getting into mid cap space. Am I correct?
Absolutely. Absolutely. They are not small cap companies, but
Right.
they are companies which are actually doing very well. They have a quite ample market cap. Even the smallest company in terms of market cap is around 8,000 crore.
Okay.
Right?
And but the earnings growth is so positive from what I saw in your portfolio that volatility will be reduced because of that earnings growth potential also.
Yes. And adding more part to it, that if you see our allocation in small cap is towards again our themes. So as I tell you, for example, healthcare and manufacturing.
Right.
If I add these two, this would cover almost 95% of entire small cap allocation.
Oh, okay.
So, like we just discussed, the growth of some of the company in the capital goods segment or engineering segment or defense segment, will be slightly higher because of the reforms and the thrust of the government and the higher capex investment. But that is where our investment in the portfolio is towards these capital goods company, capex companies, engineering companies, defense companies, and in healthcare again, hospitals, and these companies where we see a relatively higher growth than the index itself.
So let's talk about the large cap space. You have about 36%. Naturally, as we just discussed, large cap will definitely deliver good returns because FII money, emerging market index weightage increasing, etc. All that will have positive impact in the large cap.
Absolutely.
So 36% exposure to your large caps. What kind of sectors and themes are you playing?
So again, large cap also. So of course, we are looking at companies, for example, NBFCs, we have allocation to NBFC, we have allocation to banks, in our portfolio. So within teams, we have pick and choose large cap companies which will deliver a slightly higher growth than the index.
Right.
Because as a investment strategy, we tend to be investing in those companies where the investment growth is higher than the benchmark or index.
Sure.
So that is what we are striving here. So, like I said, NBFCs, on the retail bank side, we have allocation. So that's where our large cap allocation has been.
So now we've discussed about small cap and why you are at 27% in small caps, and you've given ample, clarified it amply that most of it is in that healthcare and the hospital segment, etc. And these small caps are really not small caps. They are more getting into the mid caps kind of a category. Now let's talk about your performance, which is phenomenal performance. If you see this data, which you have shared with us, versus the peer and versus the benchmark, consistently you've beaten. How have you managed this consistency in performance?
Oh, it's very difficult to answer that. How do we manage? But we stuck to our process and philosophy. So if you create a portfolio where the active calls are very limited, then it becomes very, very difficult for the manager to deliver alpha at the end of a tenure to the end investor. So what we have done is basically we have divided our portfolios into all themes. So if you look at a portfolio, for example, if let's say I have 23% allocation into manufacturing and capex company, you will see investment into 6-7 companies with a not equal weighted, but relatively balanced weight across those companies. Same you will see in the healthcare side, and same you will see in the consumption side.
So what I hear you say, Ritesh, is basically this outperformance which you have managed consistently since inception and last 1 year, 2 year, 3 year, whatever data which we take out, is basically your active management of style of management, your growth-oriented style of stock picking, the quality and the growth-oriented style of stock picking, the focus and conviction in your stock picking. So that's the reason why you're at 35%, 30 to 35 stocks versus 70-75 stocks in the other schemes, etc. So that is your secret in terms of how you have delivered this alpha on a consistent basis.
In larger mid-cap fund, I just like to highlight one more thing which I forgot to mention earlier, is that in this portfolio, we'll see we tend to invest into the best companies in the segment theme, which are high growth.
Okay.
Right. So while we are mentioning that we are investing into companies which are relatively higher growth, but we tend to go with the top companies there.
So basically, leaders in the segment, in the industry.
Top 4 or 5 players where we are aiming at. We are not trying to go at the bottom of the ladder, honestly. And you also see a very, very unique play in terms of playing on the new trends. So we should not, stay very, very backward there. So if you play on the renewables or play on the EV or play on the PLI themes through EMS, etc., you see a presence of all those themes in the portfolio. So we are ensuring that all the relevant themes in terms of the opportunity in the large cap where we see the most, the opportunities in the certain themes where we see the most, you see presence of all those themes, which we believe and we hope for that the trend should not catch up with us on that, and we tend to give a decent experience to our clients
No, no,
and
I
partners.
hope not. I hope not, both for your AMC and for the investors also, because you're doing a phenomenal job in practically all your schemes which you are managing currently. You are there in the top quartile, be it the mid cap, the large and mid cap. Now I think the flexi cap has also started performing very well. So, no, what we have covered now, Ritesh, is how do you manage large and mid cap? What is the QGLP process? What are the in-house themes and why these in-house themes are likely to play out? And what is the allocation to large, mid, and small caps, and why this allocations also? And of course, finally, the performance highlights, which is doing exceedingly well, and hopefully it will continue to do well. Now, the question which many investors have in their minds is that how come they don't have alpha in their portfolios, or how come their portfolios are not doing consistently well uh, versus the benchmarks, or versus some of the schemes which are doing exceedingly well, like large and mid cap. Now, my analysis shows, correct me if I'm wrong, is that most investors are invested in 5 to 6 mutual fund houses and 8 to 10 schemes. So if we consider 75 to 80 stocks in each scheme, almost 500 stocks is what they are buying. So if you buy the market, you cannot beat the market, is the mantra which everybody has been talking about, and reason why most investor portfolios are not able to generate alpha. Am I correct in saying, analyzing it like this?
You are bang on. You are absolutely bang on, Sunilji. If you are not differentiated your portfolio, you are actually investing in the index itself or very, very close to the index. It's very, very difficult to create alpha. It's absolutely very difficult to create alpha. So let me give an example. For example, if you look at the from a large cap segment, I can give an example. If in the top 100 stocks, okay, the returns which are coming from Nifty and next Nifty constitute a return on Nifty 100. But what if you are very, very close to the benchmark, or you're hugging the benchmark to extent of 60-70%,
Right.
your allocation to the next 50 anyway is quite minimal. Now, what we have seen is that over the last few years, the next 50 have tend to outperform the Nifty 50.
Correct.
Now, it's very difficult to create alpha there if you are hugging the benchmark and you are actually
That investors have bought the entire market by over diversification into 8 to 10 schemes, 5 to 6 fund
absolutely.
houses, etc. So, is the solution to identify two good fund houses in, say, value style, two good fund houses in, say, growth style, and maybe one fund house like yours, which is quality and growth? So if you diversify between 2 or 3 such fund houses in terms of value style and growth style of investing, and then invest accordingly and not do too much of a diversification, that is the only way which they can generate decent returns and alpha over the benchmarks. Am I correct?
Absolutely. I mean, you don't have to invest into 100 schemes. That's absolutely not the right way,
Right.
because what we see end of the day, the overlapping becomes too much between, let's say, 20-30 schemes, because end of the day, there are 150 stocks in mid cap. There are 100 stocks in large cap. So if you
कितना
buy
कितना डाइवर्सिफिकेशन कर लो?
5 large cap, तो हमको जितना diversification मिलने वाला नहीं मिलने वाला है. And
Yeah,
if
yeah.
by any chance the number of stocks are more than 60-70, then anyway, the overlapping is humongous, honestly.
Correct.
Yes, absolutely. You should stick to the best players in the, let's say, value style. You should stick to the best players in the, or top 2 players in the value style, top 2 players in the growth style. Stick with the experts in the respective styles. I think
Right.
it should give enough diversification to the client, and also
So not more than 3 to 4 AMCs of is what I'm hearing you say.
good enough. It's good enough, honestly. And beyond that, it will not going to add any
Any
value
value.
to the client's portfolio.
I totally agree. Now, 2024 is likely to be the year of growth. Last couple of years has been year of value style of investing. So am I right in saying that this is going to be year of growth? And in spite of that, all Motilal Oswal Fund, though it was, value style of investing did well over the last couple of years, but Motilal Oswal with its growth style of investing have also delivered phenomenal top quartile performances. Whereas when the rate cuts will happen, this will be huge tailwinds for growth style of going forward, especially in that small cap segment, which you have about 27% exposure. and also growth themes captured by Motilal Oswal of China Plus One, manufacturing, healthcare, all will come in play in the year 2024. So what do you
Absolutely.
have to say to that?
Yeah, no, you are bang on this. So growth
Sorry.
styles continues to thrive when the economy is flourishing. They
Right.
tend to do better when there's a more expenditure happening or capex growth is happening in the country. They tend to do better if there's a rate cut and the cost of capital is lower.
Lower.
So all these are ingredients for a company to grow profits. And growth style is all about investing to those companies which their profit growth is substantially higher than the rest of the other companies. So these are the ingredients which actually leads to the this style doing well. And the next 4 5 years, we are talking about 7% plus minus zero point 0.5 in terms of the GDP growth. We are talking about the Indian economy becoming a $6 trillion 6 7 8 trillion economy by the end of the decade. We are talking about our per capita income becoming double. We are talking about the investment by the government in the PLI to be substantially increasing. We are talking about India setting up own semiconductors factories. So all these things which are happening are basically going to help the company to grow profit, and this will, we believe, the growth style will should do very well in this environment. And we have seen in the last 2 3 years the value has delivered quite
And in
good.
spite of that growth style of investing, Motilal Oswal has delivered returns in that.
Yes,
Thank you so much,
we
Ritesh. It was such a pleasure talking to you, and going through this QGLP process, the some of the house themes, etc. I'm sure the viewers will benefit out of this interview in terms of understanding your own philosophy. In 2024, what should they expect, and how India growth story is going to pan out, and hopefully all the Motilal Oswal schemes will be in the top quartile, A, for the benefit of the investors also, and for the benefit of the AMC also. Thank
thank
you
you so
so
much,
much.
Sunil ji. Pleasure is mine. Yeah, thank you so much.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.